India's savers are becoming investors at a rapid clip, according to a research report from ratings company CRISIL. The report says India's managed investments kitty, that includes mutual funds, insurance, AIFs, pension funds and PMS, grew from 63 lakh crore in 2017 to 135 lakh crore by FY22. In other words, it grew from 41% of GDP in 2017 to 57% of GDP in 2022. Bank deposits still dominate the savers' mind space, accounting for a kitty of 170 lakh crore versus only 135 lakh crore for managed investment. But there is a steady migration from bank deposits. In 2017, managed investments formed 59% of bank deposits, or were 59% of bank deposits. In FY22 end, they were 79% of bank deposits. Managed investments have grown at a compounded annual growth rate of 16% in the past 5 years, say 2017 to 22. Bank deposits have grown at a CAGR of 10% over the past 5 years. However, separately, Reserve Bank and NSO data show that India's savings rate has been falling and is at a modest 28% as of FY21 versus a high of 37% earlier in this decade. Within this, household savings as a percentage of GDP has been stagnating around the 8.3% mark, that is the FY22 data. What do these trends in savings and investments mean for the Indian economy? Even if the percentage of savings are not growing, does the fact that more money in mutual funds and AIFs and insurance can mean more equity capital for growth? Is this in any way because of the demographic dividend? You know, more investors, more taxpayers in the economy. For all these questions, I am joined by two people who are experts at it. Professor T Ramadorai of Imperial College, London. He chaired an RBI committee on household savings a few years ago. And Dr. Pronab Sen, economist and former chairman of the National Statistics Commission, done a lot of work on savings trends in India. Tarun and Dr. Sen, thank you very much for joining me. Let me first get to you, Dr. Sen. You've seen this data over time, but this last 5 years rise in investments from bank deposits, does this mean that this can be a big fuel for growth?
No, Lata. In fact, if anything, my opinion is it represents a threat. Because what is happening is that funds are moving from a relatively fungible kitty, which is the bank kitty. Banks invest the whole range of entrepreneurs, from MSMEs right up to the large corporates. Whereas when we are talking about capital markets, it's actually restricted to a very thin layer of companies who can directly access capital markets. So what you could be getting is a situation where more and more of our overall savings are getting funneled to a relatively smaller and smaller group of entities.
Oh, okay, I didn't look at that. But Dr. Sen, India has always been wanting in equity capital. We have some kind of debt capital. Equity is more expensive. You don't think that that is a positive trend?
Well, the manner in which one does this is important. Okay. So, I mean, banks don't go in for equity. That's not in their business model. But insurance companies, on the other hand, which are including as a part of managed funds, they do go into equity, but they go into equity again in a very, very selected manner. And so far as the mutual funds are concerned, they go into equity only of listed companies.
Yes.
So, I mean, it becomes even narrower as you go along.
I take your point. Tarun, how are you looking at the same data? Is this at the margin looking positive at all? I mean, after all, growth can flow down to the lower echelons. But do you look at this march of money from bank deposits to managed investments as positive?
Look, I mean, I think it's, as with all economists, I have a two-handed view on the issue. Okay. There's a one-hand and on the other hand view.
Okay.
Maybe I'll start with the more positive assessment, which is I do think that the increasing financialization of savings is good from the household perspective. This is one group that we haven't really talked about because we've been speaking about the effects on companies and their access to capital. From the household perspective, I think this is entirely positive. We've moved from about 5% in the last All India Debt and Investment Survey as a percentage of total household assets to about 15% of the total household asset fraction of their total wealth that is invested in risky assets on the stock market. And that, I think, is positive because, most models would tell you that the right allocation is far closer to 15% and possibly even higher. For comparison purposes, in the United States, households invest about 40% on average of their assets in financial markets and in retirement savings. From the firm perspective, I also think it's beneficial because there's access to a different source of capital. I think you can argue about the questions of whether equity investment in India is actually beneficial because you might say, well, equities are volatile and so on and so forth. On the other hand, there are well-known problems associated with banks. It's not clear to me that especially public sector banks are particularly efficient at channeling savings to the most highly productive corporations. There are benefits and costs of doing both. I wouldn't by any means say that it's a risk-free kind of trend that we're seeing, but on the whole, I think I would come out and say that this is a positive development, both for households and for the rebalancing of the Indian economy away from bank financing to equity financing.
Okay, I'll come back to the value judgment in a minute, but if I can extrapolate, the CRISIL report goes on to say that over the last 5 years, it is a 16% CAGR, compounded annual growth of managed investments. And now as, the kitty of savings and the number of taxpayers grow, as India grows, this CAGR would be 19%. Would you agree that, this could grow at a more rapid clip, Tarun?
I do, and this is the statistics. I probably should have been a bit clearer, which is if I compare the results from the All India Debt and Investment Survey in 2013 to the All India Investment and Debt and Investment Survey in 2019, which is the analysis I've done, there's been over a doubling of the household financial investment share.
Okay.
It's still very far away from where it needs to be, and I think that there's a long distance to travel. Now, there is a question about where it's happening. And it seems like it's happening a lot in mutual funds and insurance. But the question is, what about retirement savings? And that's another really big hole that I think will need to be filled and will be a source of growth, hopefully, going forward.
Okay. Well, the CRISIL report does give some fairly positive data even on retirement and pension funds. It's not a great deal, but it is still growing. Dr. Sen, some of this movement towards capital market instruments, or at least much of it, appears to have come in the last 2-3 years. Do you think the trend can reverse if bank deposits rates increase, which they are now? Some of the migration could have been because savings were giving so little in the banks that it went, and it may come back when bank savings and fixed deposit rates rise. Do you think that we are judging this migration too soon?
Yeah, Lata, the thing is, the rates, of course, have a role to play. I mean, we went through, for the last 2 years, we were in a situation where the bank rates were so low that nobody in his right mind would put their money into it. Okay, the rates are now starting to normalize, which is a good thing. But there's another dimension which we need to keep in mind, which is that the behavior of savers in terms of what instruments they choose to park their money in changes with age group. And normally it's the sort of the middle age group, 40 to 60, who are heavy investors in the non-banking assets.
Channels, okay.
Yeah, the older people tend to move their savings out of finance to the banks.
Yeah.
Right. So the overall sort of the demographic dynamics will have a role to play, and at least we have some kind of prediction as to the manner in which the population dynamics are going to work out. And so if you really look at those numbers, what it suggests is no, this trend is not going to reverse suddenly.
Okay.
Because it is precisely that middle age bracket which is the growing part of the population.
Okay. So you will agree then, therefore, that there is a little more fuel for growth available, would you? Or do you think I'm making an inductive leap there?
Who did you ask that?
I'm asking you, Dr. Sen.
Could you repeat that? I'm
No.
sorry.
What I'm asking is, would you, since you're saying that it is a secular trend, that more money will go into managed investments because of demographics, does this mean more money is available for growth?
Underlying, there's a secular trend, but movements around that secular trend will be driven by relative returns.
Okay. Okay.
After all, everybody is reasonably rational.
Okay. What's your sense, Tarun? Do you think growth will get a fillip from this trend of managed investments?
So I entirely agree that there's a secular trend that will hopefully continue to be sustainable. I think part of the answer to that is also going to come from whether retirement savings are being allocated appropriately in equity markets, among other instruments. But I think I broadly agree that there will be fluctuations around the trend, but the trend is generally positive. Mm-hmm. As to the question of whether I think this is a good thing for Indian corporations, as I said, I think there has to be some rebalancing. I think one of the problems has been we still have a very, very large fraction of the economy that's financed by public sector banks. They are becoming more efficient because of competition, but they are nowhere near, I think, the levels that they need to be at. And therefore, having some healthy competition in the form of equity financing available is useful, especially given that there's an ever-increasing startup story in the country, and a very preferred exit route for startups is to invest in, is to eventually go public, to go IPO. And so a larger fraction of savings that are allocated in the stock market, a bigger market, a bigger pool of available capital, also in some ways has a beneficial pull effect on the small and medium-sized enterprises that are looking for an exit route eventually.
Okay. Fair enough. You know, there is a larger question that I have to ask, that the overall savings kitty itself is not growing, and it's not even as high as it was earlier in the previous decade. That question after a very short break. Do stay with us, Tarun and Dr. Sen.